welcome. Oasis is presenting today's webinar on understanding Canada Pension Plan. And as your facilitator, my name is Roland Chiwatalu. I am a financial wellness consultant with Eckler. And Oasis selected Eckler to collaborate on providing this support to Oasis members. Eckler is independent from Oasis, and we're financial wellness experts. We do work with other organizations across the country in developing and presenting these types of programs to their employees and members as well. A couple of housekeeping notes. So as I mentioned a minute ago, that this webinar is being recorded and it should be posted up on the resources section of the Oasis website probably around this time next week. It should be up there. So we have until the bottom of the hour for the webinar. And the way we're going to do it is, I'm going to go through the presentation and then we'll look at questions at the end. So even though I likely won't be stopping in the middle to address questions, maybe unless there's some sort of audio or technical problem that happens, please let me know if anything like that happens in the chat, and I'll just try and keep my eye on that so that I can address that if it happens. But other than that, questions on the content we'll try and address at the end. But in the meantime, just go ahead and put your questions in the Q&A. That way it's kind of in the queue, it's queued up, and then I can just address the questions at the end one at a time. You'll also be able to ask a follow-up email question if you like. So I'll show the email inbox that you can reach me with any questions that you have after the webinar. So sometimes, you just, people like to listen and then once they've had some time to think about it, then maybe they'll have some questions. So you'll be able to reach me and I'll show that email at the end. And finally, we do have a feedback survey at the end. So please, if you don't mind, it shouldn't take you long. It's about 7 questions to fill out the feedback survey. It should automatically pop up when you leave the webinar. So when the webinar ends and you leave, you'll get a new window pop up in your browser with the feedback survey. So we'll really appreciate your feedback. All right, so basically what we want to talk about today is the Canada Pension Plan retirement benefits, some of the factors involved in calculating your retirement benefit, including your contributions to Canada Pension Plan. Obviously, we'll talk about when to start receiving Canada Pension Plan. I think that for many people, that's a question that they are considering. And then we'll take a look at how you can actually go and request your Canada Pension Plan estimate as a way to help you start to plan your overall retirement income. So Canada Pension Plan includes 4 types of benefits. It's more than just the retirement pension. You can also receive disability. If you qualify for the disability benefit, you will receive a disability pension paid out of Canada Pension Plan. And basically you will receive it as long as you continue to qualify for it. Once you turn 65 and you're still getting the disability pension, it then switches to the retirement pension and you continue to get that for the rest of your life. Now, if you do pass away and you leave behind some survivors, a surviving spouse or surviving eligible dependent children, then they will receive some survivor benefits. So the spouse will receive a survivor pension. And then if you have eligible surviving dependent children, they'll also get a small benefit. So we'll talk a little bit more about that towards the back end of the presentation. And then finally, there's the lump sum death benefit. It's a one-time payment paid to your estate after you've passed away. So I like to start off this session with just a little quiz, just for fun, to get a sense of, how much you think the maximum Canada Pension Plan retirement benefit is right now. And by the way, it's anonymous, totally anonymous to answer these poll questions. And there's no, wrong marks, right marks. But we do want to see, what do you think the monthly maximum Canada Pension Plan retirement benefit at age 65 is? Do you think it's $800 a month, $1,200 a month around, or $1,500 a month around? All right, so we got about 85% of you have put in your answer. So let's end the poll right now and share the results. And yeah, so it looks like most of you went with $1,200 a month. A few of you went with $800 a month, and nobody, not many of you thought it was $1,500 a month. So that is very good. Thank you for sharing. So what is it? Well, here it is. This year, if you're 65, the maximum monthly Canada Pension Plan retirement benefit is just over $1,200 a month, or $14,500 for the year. But of course, not everyone gets the maximum. As you can see, what I'm showing below is the average of new Canada Pension Plan recipients in the month of June that just passed. The average that they received was just over $700 a month. So what you get is, if you are lucky to get the maximum, or maybe you're going to get something below the maximum, what you get is really based on your contributions, and then also when you decide to start to receive your pension. So we'll talk a little bit more about that, so it's a little bit more clear. A few more things to note about Canada Pension Plan. Number one, it is adjusted each year to keep up with the changes in the cost of living. So that's what we call inflation. This phenomenon that the cost of living, the things that you need to spend money on for running your life, whether it's heating your house or gas for your car, food and groceries, that's what we measure in inflation. And so we want to see if these prices are going up over time. And of course, we know that they typically tend to go up over time. And in fact, I think much is being made in the news these days about a higher than normal inflation that we're seeing as a result of some of the supply chain disruptions that came about, that many people experienced because of COVID. So that's something to be aware of, that once you start your Canada Pension Plan benefit, whatever you're getting, it's then automatically adjusted every January 1st to keep up with the rising cost of living, to keep up with inflation. Now, Canada Pension Plan, the retirement benefit is taxable. In fact, all the different benefits that are available from CPP are taxable. But with the retirement benefit, it's not normally deducted at source. The tax is not normally deducted at source. Now, what does that mean? Well, you're familiar with your paychecks, right? Because when you look at your paycheck, you notice that, guess what? There's some tax deducted right away. And so that's what we mean by tax deducting or tax withholding at source. But that doesn't automatically happen. Once you start to receive your Canada Pension Plan, they don't automatically deduct your tax at source, which means that you may owe some tax at tax time, right? If they're not taking some off right off the bat for taxes, then that means nothing has been taken off the bat. So that by the time at the end of the year you do your tax return, you're likely going to owe some tax. So what you can do, however, is voluntarily request that they do deduct some off of each Canada Pension Plan deposit into your bank account. So you'll do that by, when you apply for CPP, you can then also fill out a form with Service Canada that they can start to withhold some tax. And by the way, you can also fill out a form to change how much they're withholding tax, to stop them withholding tax. All that can be done via Service Canada and filling out the requisite forms. Now, Canada Pension Plan is using age 65 as the normal retirement age. So 65 is basically when you can apply to receive your Canada Pension Plan. However, you can choose to start receiving it earlier or later, and we'll talk about that coming up. So what determines your regular retirement benefit? Now, there are two major factors, right? There's the contributory period, and then there's the contribution amount, how much you're contributing to Canada Pension Plan. Let's start with the contributory period. So basically, your period of contributions starts at age 18 for everybody, age 18. That's when it starts. And then the contribution period, or the contributory period, ends when you apply to begin to receive your Canada Pension Plan retirement benefits. So if because 65 is the normal retirement age. Let's assume you apply at age 65 to start your CPP. So from age 18 to age 65 is your contributory period. That's 47 years. So every year counts. Every year there matters. But you can imagine that it's very normal to have some gap years where you're not necessarily in the workforce, maybe not in the workforce full time, maybe you're totally out of the workforce. You can think of students early on in their contributory period, they might be studying post-secondary or taking other courses and might not be working. So you're not making contributions to CPP. What if you took yourself out of the workforce in the middle of your contributory period for whatever reason? Maybe it's to raise young kids or some other reason. Also, what you can sometimes see towards the back end is you take early retirement. So what if you retire at age 55 or 60, and then you don't apply for your CPP retirement benefit until age 65, meaning that there's going to be a few years of gap there, and that would necessarily mean that you're not going to be making contributions to CPP, which could hurt you in terms of whether you're going to get the maximum or not. So yeah, every year counts in your contributory period. And then there's the contribution amount. How much are you contributing? Which you can, on each paycheck, you make a contribution. So how much are you putting in? Are you maximizing your annual contributions? Those two things are the major factors that will determine whether you get the maximum CPP or not. So I was just talking about the contributory period and how you may have some years where you're out of the workforce and thus you're not making contributions. Maybe some years where you are your earnings were a little bit lower, and so you didn't maximize the contributions in any particular year. So luckily for us, there's a recognition that most people have some gap years or they're in and out of the workforce at some point during their whole contributory period. So what happens is you automatically get some years that are dropped out of your calculation when you actually apply to receive your CPP. We call these dropout years. So everybody gets a certain number of dropout years that is meant to drop out those years that they weren't making contributions at all, or their contributions were lower. So it's meant to remove those low contribution years or zero contribution years if you're totally out of the workforce. So everybody gets up to about 8 years of their lowest contribution years taken out. Then on top of that, there's an additional dropout if you had children. So we call this the child rearing dropout. Basically, you get to add up a number of years until your child turns 7. So let's say you get to add up to 6 years for your child. That gets dropped out of your total calculations. And if you had more than one child, then we're curious about the gap in between them, the age difference in between them, because that will allow you to continue to add more child rearing dropout years. So for example, let's say you had 2 children and they were separated in age by 2 years. So what's the total number of child rearing dropout years you would get for both of your kids? Well, up to age 6, and then the younger child is 2 years younger. So they will have another 2 years until they turn 7 and you can stop calculating dropout. So the total combined child rearing dropout, if you had 2 kids separated in age by 2 years, is 8 years. 8 years plus the normal dropout 8 years. So in total, you would have 16 years in that example, 16 years of dropout. Okay, so meaning that if you retired at age 65, instead of looking at a 47-year contributory period to see how many of those years you put in the maximum contribution, it would be 47 minus 16. Right? Those of you who are good with math, you can do it quickly in your head. And so that's how the dropout years helps you get closer towards being able to receive the maximum retirement benefit. So that's the contributory period. What about the actual amount of contributions? Well, the contributions that you make during the contributory period are a major factor in calculating your CPP benefits. You contribute based on your earnings, and your employer matches your contribution. If you're self-employed, then you do both shares. So basically, you're making the normal contribution times 2. But if you work for an employer, you make your contributions and then your employer puts in the same amount as well on your behalf for CPP. Now, your income, because CPP contributions is based on your earnings. So your income is subject to contributions up to a certain annual limit. And so we call that the year's maximum pensionable earnings, which is what you can see on this column here. And every year, that year's maximum pensionable earnings, or YMPE, goes up slightly. And that's to keep up with inflation. So basically, this year, 2021, you have to make contributions to CPP up to your earnings level of $61,600. So if you make more money than that, then you basically are, at some point during the year, you're going to max out on your CPP contributions. And the contribution rate this year is at 5.45%. So this rate at this maximum pensionable earnings means the maximum contribution that you can make to CPP this year is just over $3,100. And then remember that your employer will put in that same amount as well. So Canada Pension Plan was designed so that when you receive your Canada Pension Plan retirement benefit, you would be able to replace about 25% of the average working salary through CPP retirement benefits that you will then receive for the rest of your life. So that's how it was originally designed. But there have been recent changes made to CPP so that the benefit that you get from CPP retirement is going to go up significantly, such that the target is to replace now 33% of the average working wage. And that's what you'll see here with these rising employee contribution rates. So starting in 2019, now at 2019, every employee is required to put in 5.1% of their earnings. Then last year it went up to 5.25, this year 5.45. And there's going to be 2 more years of phasing in higher contribution rates so that by 2023, we're all going to be contributing 5.95% of our earnings. And then the maximum pensionable earnings number is also going up. It's been going up to keep up with inflation, but there's going to be additional increases such that by 2025, the year's maximum pensionable earnings will be increased up to about $82,700. So both of those two changes combined is what is going to help increase the retirement benefit significantly, but it will mostly impact those that are younger today, right? Because if you're already getting close to receiving your CPP retirement benefit, then all your contribution years going backwards, you've been contributing at under 5% of your earnings all those years. So these new higher rates of contribution are really going to be a bigger impact for those who are young today. Okay, so you don't necessarily have to stop working in order to collect your Canada Pension Plan benefit. You can actually receive your Canada Pension Plan and still work. So any contributions that you have made after beginning to receive your pension, because you can see there, if you're working, you have to contribute to CPP if you're working and you're under 65 years of age. But when you turn 65, and if you're still working, then you have the option, it's voluntary, whether you decide to continue to contribute or not. Okay, and then at 70, no more contributions, whether you're working or not. So what is the impact of making contributions and at the same time, you've already applied to receive your benefit? Well, you will get a new additional benefit that's called the post-retirement benefit. It's basically a new benefit that's added to your CPP benefit. So even if you're already collecting the maximum available Canada Pension Plan for you, and you are still working and making contributions to CPP, you're going to build a post-retirement benefit. You're going to build even more of a benefit on top of the maximum. So how much you're going to get, depends on your earnings and depends on your age. if you are still making contributions to CPP while you're receiving your benefit. So that will help determine what your post-retirement benefit is going to be. If you're curious, because if you're sitting here thinking, that this might apply to you, that you might see yourself working while receiving your CPP, then you might want to look at a estimate of what you might get from the post-retirement benefit, which is available on the Service Canada website. They have a good retirement calculator that can help you calculate those post-retirement benefits. Okay, so another major factor in how big your CPP retirement benefit will be is the age you are at when you apply or when you want to start to collect your CPP retirement benefit. So remember, we said age 65 is the normal retirement age. It's the age that the program was designed to provide benefits to. But if you want to, you can actually apply to receive and start your CPP earlier than 65, or wait, what we call defer. You can defer it past the age of 65 for a number of years. So what happens is, if you want to take it earlier than 65, you will be, they will calculate a reduction to your benefit. And a reduction is calculated because if you start it before 65, think about it, you're going to collect it for a longer period of time. So they reduce the amount. And then if you defer it past 65, they calculate an enhancement to your CPP, again, because you're collecting it for a shorter period of time. So they increase the amount. But you can see the reduction for taking it early. It's about 0.6% per month, or 7.2% per year for every year you're younger than 65 when you start to get your CPP. And the earliest you can get it is age 60. So basically, this age 60 pension will get a 36% reduction versus what you would get at 65. And then the opposite is true. If you wait, you get an increase of 0.7% per month, or 8.4% per year for every year you wait after 65. And the longest you can wait where you get this increased amount is 5 years after 65, meaning if you wait all the way to age 70, you're going to get a 42% higher CPP than what is available at age 65. So most people actually decide to take it early. In fact, the vast majority of folks decide to take CPP as soon as they can, meaning age 60. And then very few wait until age 70. In fact, just around 1% of people wait until 70 to start their CPP benefits. And, if you do take it early, or what I should say is, those who are taking it early, making the decision to take early, the vast majority of them are actually making a financial mistake, because here's basically what the situation looks like. This graph here, we're showing you the 3 different ages. Now, you can take CPP at any age between 60 and 70, but just for simplicity, let's assume and let's compare. If you start CPP at age 60, which is the orange line, remember, when you start your benefit, that's what you get for the rest of your life. It's just going up to keep up with inflation. So that's what we're showing here. The age 60 benefit is reduced compared to what you get at age 65. However, you're starting it 5 years earlier. So once you started at age 60, you're getting your benefit. But if you started at age 65, eventually the total CPP payments you've received will be higher compared to someone who started it at 60 by the time you get to age 73. Age 73 is the crossover point when we're comparing starting CPP at age 60 or age 65, right? So if you live past age 73, you will receive more in total CPP payments if you start your CPP at age 65 instead of 60. And then you can see the difference grows over time. All right, what about age 70? Let's compare age 70 to age 65. That crossover point is age 81, okay? So if you live into your 80s and beyond, you're better off taking your CPP at age 70 instead of age 65. And then if we compare age 70 to age 60, Well, that crossover point happens in your mid 70s, age 77, around there, right? And then you can see the difference grow significantly, so that if you live, let's say, to age 95, that difference of starting CPP at age 70 instead of 60 has resulted in you collecting 6 figures more in total payments. This is a big difference. And this is where I'm saying you might be making a financial mistake by taking your CPP early. Most of us underestimate how long we're going to live, right? So longevity obviously is a big factor here, which you'd have no idea how long you're going to live. If you knew, then you'd always make the right decision about when to start your CPP. But we don't know how long we're going to live. And most people make the classic mistake of underestimating their longevity. So what is average longevity looking like today? Well, if you make it to age 65, right? Assuming you make it to age 65, a female is expected to live until age 89 on average, which means some people will not make it to 89, but some will live past age 89. What about a male? If a male makes it to 65, their life expectancy is age 88, okay, on average. So that's a good indication of the type of longevity we have and are expecting. So that is a factor into when you should think about starting your CPP. It's not the only factor, of course, but you might have to think about other factors like, well, will you be working in retirement? So if you think that you're going to be working in retirement, how is that going to play a role into your overall retirement income picture and your tax rate, right? So does it make sense to start your CPP early if you're still going to be working maybe part-time or start a business in retirement for a few years? That CPP that you've taken early is just going to increase your taxable income. So if you don't need it, it doesn't make sense to start taking it. But you might need it. You might have financial obligations that will require you to take your CPP early. So, what if you're taking care of an elderly parent or a partner or spouse that gets sick and there's increased financial obligations for you? That is a good reason to tap into your CPP early if you need it then. But if you don't have those pressing obligations that hit you and you have normal life expectancy that you're expecting, it makes sense to think about waiting till at least 65, and then you'll have even more benefits by waiting past 65. Other sources of retirement income. So what are your total retirement income picture looking like? And how important is CPP to you? So remember, I talked about Canada Pension Plan was designed to provide about 25% of the average working wage. Well, for you might rely on CPP even more if you don't have as many other sources of retirement income, or the opposite is true. So think about that in terms of how important is CPP to you. And you might have gap years like we talked about that aren't totally going to be removed by the child rearing dropout. So classic example is, and not just the child rearing dropout, by the general dropout. So classic example is if you immigrated to Canada. So immigrants come into Canada usually in their prime working age around, mid 30s to 40s. So the thing there is, if you immigrated to Canada, Canada Pension Plan contribution period starts at age 18 for everyone, whether you were here or not. So imagine it started at 18, you weren't even here in the country, probably not until your mid 30s. So that's a 20-year gap in some cases. That's going to mean you're not going to get the maximum. So based on that, you might decide either to postpone receiving your CPP benefit to increase it as much as possible. And also you may have lost CPP from an earlier divorce. So all of these things are factors. It's not so cut and dry to think about when to start taking CPP. You do want to think about all of these factors and maybe talk to personal financial advisors, or talk to people that you trust to get some more information and to think about things more before you apply, before you decide when you want to apply for CPP. So, Canada Pension Plan sharing benefit. This is basically something that spouses can do. If you have a spouse or a common law partner, you can split or share your CPP benefit. And essentially, it could result in tax savings. So you do have to apply for it. You and your spouse must be at least age 60 to be able to apply for this CPP sharing. And the amount of Canada Pension Plan that is split between the two of you is based on the cohabitation period, meaning that the period of time that you are married to your spouse, or if you're common law, that you are living together common law, and all of your contributions into CPP and your spouse's contributions into CPP during that time is what eventually gets split and paid out to you once you start to receive your benefit. So it could help in saving some taxes for you. So all this talk about the retirement pension, I think a good planning tip is to go and request your estimate, request your statement of contributions. They used to mail this out to everybody, but a number of years ago, they changed their approach to now they wait for you to request it before they send it to you. So you can go ahead and call them there to request your statement of contributions and your estimate, and they will mail it to you. Or if you want to do it online, visit the Service Canada website, and you can sign up for the My Service Canada account, which basically you can see here. You basically can request a number of different services through the My Service Canada account. So you can, if you ever have to go on EI, you can look at your EI status and correspondence there. You can go and pull up any tax slips, your EI payment information, your records of employment for that. So you can see a lot of EI services are done through the My Service Canada account, but also Canada Pension Plan and Old Age Security as well. So basically, you can, through the My Service Canada service, get an estimate of your monthly CPP benefits. And this is basically what you get. You'll get a record of your contribution period from your 18th birthday to present. And then they will also estimate your retirement pension at age 60, 65, and 70, so that you can see how it is adjusted based on whether you want to take it early at 65 or later. And then you can actually go ahead and apply right on the My Service Canada service. All right. Now, we talked earlier about CPP disability. CPP disability is eligible for anybody who suffers a severe and prolonged disability. So it is quite a strict definition to be able to qualify for it. And it has to be a disability that prevents you from doing any occupation, not just your own or regular occupation, but any occupation. So it's a very strict definition to qualify for it. But if you do qualify for it, you will get CPP disability benefit, which the disability benefit, the maximum this year is slightly higher than the retirement benefit, you can see. But once you are 65, if you're still collecting the CPP disability benefit, it changes to the retirement pension, and you'll continue to get the retirement pension for the rest of your life. Okay, our last quiz of the day. This one is on the survivor's benefit. So if you have a surviving spouse or partner, if you pass away, they can apply to receive a survivor's pension, and they will get a percentage of the benefit that the deceased spouse is expecting to get. So what is that percentage? And that's what we're asking you here. Is it 60% of the deceased spouse's pension, 75%, 90%? What do you think? All right, the guesses are coming in. And let me end the poll now and share the results. All right, so the vast majority of you know the right answer, which is the maximum CPP survivor's pension available is 60%. 60% of the deceased spouse's retirement benefit that they're either collecting or expecting to get. So how the CPP survivor benefit works is that it's based on age and for how much and for how long the contributing spouse paid into CPP. So first, what they're going to do is calculate how much the CPP pension is or would have been For the contributing spouse, if that contributor had been 65 at the time of death, then they make another calculation based on the surviving spouse's age at the time of the contributing spouse's death. So if the surviving spouse is 65 or older, they will receive that maximum survivor's pension of 60% of the contributing spouse's retirement pension. Okay, and you can even receive the survivor's pension, which you get for life. You can even receive it even if you remarry. Even if you remarry, you will continue to receive the original CPP survivor's benefit that you were getting. Okay, so remember, it is for life for the surviving spouse. Now, what if you combine the survivor's pension with your own retirement pension? How does that work? You can combine them, but the total pension amount that you will get, right? So your survivor's benefit plus your own retirement benefit, the total, the maximum available is the maximum retirement pension amount. Get that? So let's say, for example, that you're receiving a CPP survivor's benefit. Then you go to apply for your own retirement benefit from CPP, and let's say you're eligible for the maximum retirement benefit. Well, then you lose your survivor's benefit because the combined maximum amount is equal to the maximum retirement pension. All right, so keep that in mind. Other survivor's benefits that are available, there is a Canada Pension Plan Children's Benefit if you have eligible dependent children when the contributing parent passes away. So this survivor's children's benefit is based on eligible dependent children. And to be an eligible dependent child, that child has to be under age 18, or they can be over 18 to under age 25 if they're in full-time post-secondary school. And so as long as they are an eligible dependent child, they will receive the children's survivor benefit, which is this year around $257 a month. So for the child, it's not a survivor's pension for life. It's a benefit that they can receive and collect as long as they are eligible dependent children. But with the spouse, it is for life. And then there's the one-time lump sum death benefit of $2,500 that's going to be paid to the estate upon death. So I think we understand a little bit more about Canada Pension Plan. Just some key takeaways. You do want to make sure that you are tracking your CPP statement of contributions, not only just to see what your estimate retirement pension is, but it's a way for you to catch and fix any errors. Because if there's errors on your contribution record, that onus of catching it and fixing it is on you. It's not on your employer. It's not on the government. It's on you. So you should get into the habit of at least once a year requesting your CPP statement of contributions to make sure that the contributions that are recorded on your record are accurate, right? So you can do that by, first of all, getting your T4 from your employer, and then around July, request your statement of contributions for CPP so that you can make sure that the numbers are matching. The number on your T4, which your employer is saying, this is how much you contributed to CPP, and this is how much the employer matched, those numbers are showing up on your CPP statement of contributions around July when you request it. So you need to do that to make sure that you catch any errors, because you can imagine, you know, contributory period that spans decades, if there's an error in there, that could play a big role in impacting your CPP retirement benefit that you're going to get. And then, of course, you know, request your CPP estimate because it'll help you with your retirement income planning. Make plans to apply ahead of your intended start date. You know, I think it makes sense to apply a few months ahead of when you want to start receiving your benefit. Now, if you go onto the Service Canada website and you apply online, they will say that they typically process your application in about 8 to 12 weeks. But of course, you can write to them to apply. You can do a written application, and it takes longer. And even if you do an online application, sometimes there are delays and it could take a little bit longer. So I'd say give yourself a few months ahead of time to apply. And then review those personal factors to help determine when you should start your CPP payment. Don't underestimate your longevity and sell yourself short where you might be wishing that you waited a little longer to start your CPP rather than taking it early. A good example of this is, thinking about your long-term care needs towards the back end of your retirement. I think COVID has really opened up a lot of Canadians' eyes about the really challenging situations of our long-term care system in this country. And it's not just thinking about long-term care in a long-term care facility. I think many people want and have a plan to age in place, to age in their home, but that means you might be having care being taken place in your home, and that still costs significant amounts of dollars. So if you get this decision right about when to start your CPP, it can go a long way in making sure you have the resources at the end of your retirement to be able to pay for the type of care that you like, the type of care that you want to receive, where that care is taking place, who is providing that care, right? So you'll have a lot more choice and control rather than what the public system can provide, which we can see through COVID is not adequate at all. All right, so those are the key takeaways. Hopefully this has been helpful. I see there's a number of questions in the Q&A and in the chat. So if you do want to email me your question instead, feel free to use this inbox here, go@eckler.ca. And if you're going to leave now, because we're going to start to look at the Q&A portion. So if you are leaving now, please take a minute to fill out the feedback survey that pops up in your browser when you quit or when you exit. So now let's take a look at the questions. I'm going to actually start in the chat because I noticed a few questions in the chat, and then I'll go to the Q&A box. So one question in the chat here says, do we get more CPP on retirement depending on the returns the fund manager able to generate? So that is a good question. No, so the Canada Pension Plan benefit that you receive is based on your earnings and based on your contributory period. And so you're right that our contributions that we make go into an overall fund. And the Canada Pension Plan Investment Board is the organization that manages the fund for all of us. And you should know that that fund gets audited every few years. It gets audited every few years to make sure that there's enough money in the fund to pay every Canadian's CPP retirement benefit for at least the next 75 years. So those audits have been happening regularly every few years. And we continue to get really good results showing that the CPP fund is being well managed and there is enough money in the fund to pay out everybody's benefits for the next 75 years. So you will get your CPP, almost certainly. Okay, you will get your CPP. All right. What about for naturalized citizens who contributes 10 years or less or only for 15 to 20 years? Yeah, so I think I answered that question later on when I was talking about those who became citizens naturalized by immigrating into the country. Yeah, age 18 is when the contributory period started. So if you weren't here for those first early 10, 20, 30 years of contributory period, you're likely not going to get the maximum CPP retirement benefit available to you. Even when we calculate your 8 years dropout and your child rearing dropout, it's likely that you won't. So yeah, that's something to think about. What happens to the CPP if someone dies at 70 or earlier? Will that go to your state? If yes, how much? So I think I answered that question there as well. Also, if you didn't receive your CPP benefit and then you died, So if you die before starting your CPP retirement benefit, the lump sum, the one-time lump sum payment of $2,500 is what goes to your estate. Otherwise, yeah, that's the situation with CPP. If you do start your CPP and then die after that, payments stop unless you have a surviving spouse or partner who can apply to receive the survivor's pension that they will get. So yeah, we addressed those questions. How long does one continue to receive the regular retirement benefit from age 70? If you live beyond 100, you continue to receive the benefit at the same rate. Right, so when you receive your CPP benefit, you then will collect it for the rest of your life, no matter how long you live. If you live to 100, 120, 150, you will get your CPP benefit. And then each year, the CPP benefit gets adjusted for inflation. So remember those two things. Now, we also looked at whether you are starting your CPP early or later. If you start it early, you get initially a reduction, and then it's adjusted for inflation every year after that. Then if you start it later, like at age 70, you're going to get more. And then on top of that, you get the annual inflation adjustments. Okay. So I think that answers the question. When you go onto the CRA site to see the statement and or estimate, when can you apply the dropout years, or are they calculated when you request? Yeah, so it's not the CRA site. CRA is the tax department, so Canada Revenue Agency. This is the Service Canada department. So when you go onto the Service Canada and request your statement, yes, the general dropout is calculated for everybody, okay? But the child rearing dropout is not, because for the child rearing dropout, only one parent claims all of those child rearing dropout years. So you actually have to indicate it on your CPP application form that you are the parent that's claiming all the child rearing dropout years. So it's not going to be reflected on your statement. All right, now I'm going to look at the Q&A for a bit. Can you claim at 60 and still contribute through self-employment? Yes, you can, for that question there. What about the people who only worked for a few years in Canada because they came? Yes, I already answered that question, I think. Sorry, you request your CPP from employer in July to make sure it matches T4 or the government. So yeah, when I was talking about making sure that you are going to request your statement of contributions to make sure that you catch any errors. And I said that probably the time you'd want to request your statement of contributions is around the summertime, somewhere around July or August. And the reason I said that is because, for one, you get your T4 from your employer usually around February, March, April, so that you can do your tax return. And the statement of contributions usually gets updated around after taxes have been done. So around the summertime, July, around there is when I think is a good time to take your T4, right, that you already got around February or March, and request your statement of contributions from Service Canada to then check to make sure that the contribution record that was on your T4 is being reflected on your statement of contributions. Question that said, will I be sending out the PowerPoint? I will not be sending out the PowerPoint. This webinar is being recorded, and the recording will be posted on the OASIS website. How will this affect my RRSP contribution to my CPP? So your Canada Pension Plan contributions does not impact your RRSP contribution room. So question, sorry, me again, I missed what you said. If you take early CPP or hold off if you have other resources to sustain funds for later care. Okay, so I think what I was talking about here is, and maybe what I'll do is I'll go back to the slide that we were looking at when I was making this comparison. So remember this slide, right? And this slide is showing you the difference in the total accumulated CPP benefit that you get over time. So remember, if you start your CPP later, you get more, and then you continue to receive an inflation adjustment each year. So if we compare starting your CPP at age 70 versus age 60, you're getting an annual pension that's much higher, right? In fact, let's say you are getting the maximum benefit available this year. Well, if you started at age 70, then you're expecting to get around $1,500, $1,600 a month. But if you want to start it at age 60, then you're getting somewhere around, and I'm not 100% on the, I'm doing the math very roughly in my head. So don't take these numbers as perfect. But your benefit will be reduced by 36%. So the maximum right now at age 65 is $1,200. So 36% less than that is like $900 a month. So what is that? That's about, let's say it's $9,000 a year. So compare $9,000 a year if you start CPP at age 60 versus $16,000, $17,000 a year if you start your CPP at age 70. And that those amounts continue for the rest of your life. They keep adjusting for inflation so that by the time you have reached 95, the person who started their CPP at age 70 has collected well over $100,000 more than the person who started their CPP at age 60. So that extra money can be very useful to you in the latter half of your life when you're paying for your care, your long-term care needs, right? So that stage of your life is you're mostly paying medical expenses as well as your other housing needs and food and stuff like that, but you have a lot of medical bills. So having that extra money can help, and that's the point that I was making. All right, let me keep it here and go back. So a few more questions. At what age the survivor will receive the CPP? The surviving spouse will receive the CPP when they apply. When they apply. So if you lost your spouse or partner, then you can apply to receive your CPP survivor's benefit, and you get that for life. Now, if as a surviving spouse, when you apply to receive your survivor's benefit, you are already 65 years of age at that time or older, then you are eligible to receive a bigger survivor's benefit. That's the significance there with the age. So let's see, another question. Can I see my employer CPP contribution in the My Service Canada account? Yeah, so you'll get your full statement of contributions, and that includes the contributions you made and your employer made. I have been working since the age of 18 and have not had a pension plan other than tax deductions. Will I still get maximum benefit? So remember, the question here is the maximum CPP takes a look at your contributory period. So starting from age 18 and throughout your contributory period until you apply. So that's one factor, yes. But the other factor is your the amount of your contributions each year. So both of those two things are necessary. If you contributed every year from starting at age 18, and you also contributed the maximum each year, then yes, you will get the max. So you will see that on your statement of contributions. If you request your statement of contributions, it will show every year how much you and your employer contributed. And beside that number, it will show an M. The M means you maximized your contribution for that year. So if every year in your statement of contributions, you see an M, that means you've been putting in the maximum every year. And so you know you will get the maximum, assuming you continue to work until you retire and you continue to contribute the maximum. All right, someone mentioned that because I've contributed to RSP, that will reduce my CPP. No, that is not true. All right, thank you. Can you request from Service Canada retroactively? If I'm understanding the question, can you get your CPP benefit retroactively? Well, so how should I answer this? It is possible to get retroactive. Okay, so you can apply anytime between age 60 and age 70. Age 70 is the latest that you can apply and get an extra benefit for waiting those extra 5 years after age 65. But once you've turned 70, there's no point in waiting any longer, because 70 is the last year that you can get an increase to your benefit. So you should apply no later than age 70. But what if you forgot or something? Let's say you forgot and now you're 71. Can you get a retroactive payments? Yes, so the CPP in that case will pay you retroactively to a most going back the last 11 months. All right. Someone asked, I would like to get slide 13, this slide that I'm showing, sent to you. No, so remember, again, I can't send you the presentation, but the recording, this webinar is being recorded. And you will have the recording available on the Oasis website. All right, someone said, thank you, been telling my husband this. Thank you for the proof. You're welcome, you're welcome. There is no option now to see employer CPP contribution on the Service Canada website. I'm not sure about that. So remember, you can request your statement of contributions, and your statement of contributions should show total contributions, yours and your employers. Sorry, I meant the statement comparing your T4 to see if any mistakes from Service Canada in case there was a mistake in the past. Yeah, so I think I explained that already. Okay. No more questions, I think. Going back to the chat to see if there's one more that I missed. If you started at the age of 64 years old, and is Service Canada will adjust it at the age of 65? No, no. So whatever your age is, when you start your CPP, the adjustment is made, and that is your benefit for the rest of your life. It will only go up to keep up with inflation, right? So the annual inflation adjustments, or if you are working and making new contributions, then you will get that extra post-retirement benefit. Okay. All right. So hopefully that answered your question. All right. Another question, hand is raised. So go ahead. I'm still here. I see that someone raised their hand. So go ahead and put your question in the chat or the Q&A. Oh, everyone else, if you because we're approaching the bottom of the hour now, please, if you are leaving now, take a minute to fill out the feedback survey. And yeah, the feedback is really helpful, so that if we're able to provide additional topics in future sessions for you. One of the questions we're asking is, what topics would you like to get future sessions on? So that's really helpful if you fill out the feedback survey. Okay, so another question came into the Q&A. Why does CPP go to spouse or partner and not an adult, child, or friend? Seems singles are discriminated against, single people who lose their CPP at death. So yeah, very interesting situation, right? Because if you, basically the rule is your payments stop, your CPP retirement benefits stop when you die. They stop when you die. So that's how it goes. But if you do have a surviving spouse or eligible dependent children, which are typically minors, or if they're in school full-time up to age 24, just before they turn 25, they can also receive a benefit. So yeah, you're right. It is true that if you're single, you don't have a surviving spouse or any eligible dependent children, there's nothing there besides the one-time lump sum $2,500 that goes to your estate. So yeah, that's the situation that we have. Okay. For a couple, each only apply for CPP and they will receive it separately. Correct. But you can apply to have your benefit shared. So what happens there is that the benefit is split between the two. So I'll give you an example. Let's say one spouse is collecting $1,000 a month from CPP and the other spouse is collecting $500 a month. So the total that both are getting is $1,500 a month. But if you elect to have your benefit split, it gets split. Each benefit will get split into two, and each spouse will receive an equal share of that. So the $1,000 that one spouse is getting gets split 500 each, and then the 500 that the other spouse is getting gets split 250 each. So in total, you're still getting the $1,500 a month. It's just now it's more shared evenly, and that could be beneficial for taxes, for tax reasons, right? So instead of the one spouse having $1,000 of taxable income on their income tax, now they have 750, right? And so you can see how it can potentially save money for taxes. All right, so we are at the top of the hour. Hopefully you all found this very valuable. Thank you for your time.